IAS 33 Earnings per Share, EPS, establishes principles for calculating and presenting earnings attributable to ordinary shareholders. EPS is one of the most widely used financial performance indicators because it links profitability directly to shareholder ownership and allows comparison between entities of different sizes. Investors, analysts, and stock markets rely heavily on EPS when evaluating profitability, valuation, and future growth potential. Comparability is particularly important because differences in capital structures, share issuances, and financing arrangements can distort performance analysis if EPS is not calculated consistently. IAS 33 therefore standardizes the methodology for calculating both basic and diluted EPS, ensuring that financial statement users can compare entities fairly and assess performance trends accurately across reporting periods and international capital markets. EPS trends are often considered more meaningful than overall profit trends because EPS reflects profitability available to each ordinary share rather than total profit generated by the company. A company may report rising profits while simultaneously issuing substantial additional shares, resulting in reduced earnings attributable to each shareholder. Conversely, stable profits combined with share buybacks may increase EPS significantly. By incorporating the effect of changes in share capital, EPS provides a more accurate measure of shareholder returns and performance efficiency. Investors frequently use EPS growth trends to assess management effectiveness, future dividend potential, and market valuation. This makes EPS an essential indicator for investment analysis, equity valuation, and decision-making within financial markets and corporate reporting environments. For EPS purposes, earnings generally represent profit or loss attributable to ordinary equity holders of the parent entity after deducting preference dividends and similar distributions. The numerator used in EPS calculations reflects profit available specifically to ordinary shareholders. Basic EPS is calculated by dividing attributable earnings by the weighted average number of ordinary shares outstanding during the reporting period. The weighted average approach is necessary because share capital often changes throughout the year due to share issuances, repurchases, conversions, or other corporate transactions. Proper identification of earnings attributable to ordinary shareholders ensures that EPS calculations accurately represent returns generated for investors holding ordinary shares and enhances consistency and comparability within financial reporting practices governed by IAS 33. IAS 33 requires different EPS calculation methods depending on changes in ordinary shares during the reporting period. When the number of shares remains constant throughout the year, calculation is straightforward using total shares outstanding. If shares are issued at fair value during the year, the weighted average number of shares must reflect the timing of issuance. Bonus issues and stock splits require retrospective adjustment of comparative EPS figures because they increase share numbers without changing entity resources. Rights issues require special treatment because they contain bonus elements due to discounted subscription prices. When multiple changes in issued shares occur during the year, weighted averaging ensures that EPS reflects the varying proportion of shares outstanding over different reporting periods accurately and consistently. Diluted EPS provides additional information regarding the potential reduction in earnings attributable to ordinary shareholders if convertible or potentially dilutive instruments are exercised or converted. Potential ordinary shares include convertible debt, convertible preference shares, share options, warrants, and employee share schemes. Diluted EPS is important because it alerts investors to future dilution risks affecting ownership percentages and earnings available per share. The calculation adjusts both earnings and the weighted average number of shares to reflect the assumed conversion of dilutive instruments. For example, convertible debt requires adjustment for after-tax interest savings, while share options are treated using treasury share methods. This approach provides stakeholders with a more conservative assessment of future shareholder returns and capital structure impacts. IAS 33 also addresses anti-dilutive circumstances, which occur when inclusion of potential ordinary shares would increase EPS or reduce loss per share rather than dilute it. Anti-dilutive instruments are excluded from diluted EPS calculations because their inclusion would distort rather than clarify performance information. For example, options with exercise prices above market value or convertible instruments that increase earnings per share are considered anti-dilutive. Determining whether instruments are dilutive requires careful analysis of their impact on earnings and weighted average shares outstanding. Excluding anti-dilutive instruments ensures that diluted EPS reflects only genuine potential dilution risks and maintains the reliability, comparability, and usefulness of EPS information provided to investors and other financial statement users. Overall, IAS 33 provides a comprehensive framework for calculating and presenting basic and diluted earnings per share within financial statements. By standardizing EPS calculations and requiring adjustments for changes in share capital and potential ordinary shares, the standard enhances comparability and transparency in financial reporting. EPS serves as a critical performance indicator because it links profitability directly to shareholder interests and supports investment analysis, valuation, and capital market decision-making. The distinction between basic and diluted EPS allows users to assess both current and potential future shareholder returns while understanding dilution risks associated with convertible instruments and share-based arrangements. For DipFRS candidates, mastering IAS 33 is essential because EPS remains one of the most closely monitored indicators in global financial markets.